Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London UK feed wheat. Hello and welcome. Before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of these patterns, levels, analysis, or on any related items on these, my charts. This was all my own original work, as I think you deserve to have that. So with that, Paris milling wheat had been here in the past, one dominant pattern over all this market that 25 weeks ago took a break on the downside. And I still mention it now because it is important. You can still see it in the top left-hand corner of my daily charts. Of course, the late August 24 to late February 25 ascending triangle pattern. This pattern had the requisite combined 5+ touches and is made up from a lot of smaller patterns within it. But parts of the main pattern can still just be seen. 25 weeks ago, I laid out targets below for this pattern of a primary target down at 226 and a secondary hard to reach target down at 194. 24 weeks ago, prices reached the primary target, but we kept shying away from that 200 level, enough that I chose 10 weeks ago to retire the secondary target at 194. And we then started forcefully approaching that 200 level again in early August, and I started wondering whether to reinstate that 194 even target. Last week those thoughts became moot as prices reached down and managed 194.25, and this week we went fully below it, though we have not stabilized underneath it as yet. In the meantime, my thoughts and attention were drawn to other interesting patterns. The first had been the bright red, once more realigned, been realigned so many times, once more realigned March 24 today uptrend, currently at 193. This has been tested a number of times since its establishment back in late May, but it had held back then. Importantly, back 4 weeks ago, I said about how back then and the now important purple middle time, currently which is around at 202, of the mid-March to mid-May bearish shift pitch had, now remember, this is back then 4 weeks ago, and I quote, runs through the bright red uptrend late next week, and if there was ever a time when you could knock out two supports at the same time, then that would be it. So I would advise caution ahead of a possible further testing on the downside, end of quote. I've gone even further 7 weeks ago when I said, and I quote, I'd watch this bearish shift pitchfork, especially the middle time, as we seem to be running out of time. You see, what I mean is that the middle time crosses down through the bright red uptrend in about 4 weeks. Well, this has now obviously happened, but I continued. At the end of July, and I suspect before then, something will have to give. Add to this the pressure above from the medium moving average, which is currently 208.5, and the static 50% absolute Fibonacci line, which is way up above. And it may be that we see a test down towards the July 2021 low at 197.25. Watch this space, end of quote. All these came together 3 weeks ago, and we are seeing the resultant follow-on move lower over the last 2 weeks, plus this week as well. We may possibly carry on lower in the weeks to come. We have not done a lot in a lot in a relatively short amount of time. So we will still have to look at the downside. And apart from the already mentioned supports, we now need to look to the March 21 low at 191.75, plus the purple lower time, currently at 190.5, along with the coincident congestion this week that's also there at 190.5. However, if these downside levels are breached and broken, then the very existence of the battered bright red uptrend will be at stake, as the next support is the origin of the uptrend itself, the March 2024 low at 187.75. Thus, in all this, keep an eye throughout on the bearish mauve shift pitchfork, as it is running the show right now. Minneapolis wheat. The sideways triangle over February to May had run this market lower by mid-May, but then we saw the impact of the slightly realigned dark blue September 2019 today uptrend. Originally way below the market, but now a lot closer, and that's currently at 576.5. As well as a congestion below the market, but a little higher up at 578.75. Those together turned prices higher in mid-May, with the added impetus of a changeover gap higher at the same time. The market then rose up to the important July 23 to date downtrend, it's currently at 635, in mid-June, and peaked there twice. The second time in early July created a very lopsided late May to mid-July head and shoulders top. Since the creation, prices had a devil of an effort pushing down below the bright red neckline, which is currently at 597.25, but they eventually did so in late July, though they still haven't fully let go of it, including what we saw during the middle of this week. They have more or less stayed below it and travelled lower as well. I surmised last week that this might be a function of the steep nature of the bright red neckline. I still think that is true. Now, I said 4 weeks ago, and it is a long quote, though it still has a number of valid points, and I quote, "For a break lower, we would have a primary move below the neckline of 23.5 cents, with secondary harder to achieve move of 50 cents. I would add a caveat to the full move lower to watch out where the September 2016 to date uptrend is at the time, as I think that might lead to a possible higher secondary target." End of quote. Looking today with a break below the bright red neckline, and hopefully that isn't a false break, I can give a primary target X below in the 580 zone, so not too far away, with a secondary harder to reach target X1 down in the 555 zone. So how does this fit in with the supports below? Well, target X is very interesting as it is just above historical congestion at 578.75, which I've already mentioned. Plus the rising September 2019 to date uptrend, currently at 576.25. We have a lot of support just after it that is getting closer each week, and that is without even mentioning the lows in March, May and January this year, and also earlier in November and December last year. So you can see we have a lot of supports below. However, all that being said, we are also possibly on the threshold of a really big pattern, a December 2024 to date possible cat's ears pattern. This is a bearish pattern, but the discussion of this will have to wait for another day and the venue, as that is quite a long-term pattern. But I urge you to just remember this idea in case I have to deploy it. London UK feed week. Okay, so there had been on this chart until early July and running for about a year, one major significant pattern here, a pattern that we have not seen in the other grain markets. Now, I still have this on my daily chart for a reason, and is the bright red late May to early July 2024 bearish shift pitch fall. In early July, due to changeover, we had a very large gapping move higher up and out of this pattern, beyond the bright red upper time, which is currently 166.70. Now, please remember that level and also the bright red upper time, as it will show up again shortly. Now, added to this upper time, we had higher up the important, even today important, 50% absolute Fibonacci line at 180.5. And you had there, and even now still have, an area overhead that is significant resistance, as it capped the market on its rise back in July with some added help nearby from the purple July 23 to date downtrend, currently 180, 185. Since that peak, we've seen prices ease lower. Last week down below the gold long moving average, currently at 170.35, and the 50% Fibonacci line of the May 24 to July 25 move at 169.70, and finally start to test the combination of the May 23 low at 168 even, plus the previously mentioned bright red upper time, that one, and the very important dark blue neckline extension to a pair of very long-term patterns, which I will detail now. Both these on this chart are currently at 168.05. This all leads me to my final 4 points. The same 4 points I've been discussing for months now, and 3 of them were something that I noted back in my annual commentary back in January this year on London UK feed week. To see these, it's best if we switch to my longer term monthly charts. Firstly, I saw back then the potential for a very large May 23 to date cat's ears pattern. This is a bearish pattern, akin to a double top, formed after a big fall, such as the fall we had earlier in 2023, as well as an even longer term second pattern, an August 2020 to date very large head and shoulders top pattern. These two super long-term patterns both rely on one single feature, and that is their common neckline, which here is highlighted in purple on my monthly chart and is currently, as I said earlier, in my daily chart at 168.05. Thus, a primary target X3 for the bearish cat's ears pattern will be down in the 127.5 zone, just below the bright red and big old 2005 to date uptrend, currently at 131.60. A secondary hard to reach target X4 will be down in the 112.85 zone, around where the dark blue lower trend line is, which is currently at 113.90. And that's for the 2007-2022 ascending expanding wedge pattern. For the head and shoulders top, we would have an even lower primary target X5 down in the 64.20 zone, close to where sits the oldest uptrend. The oldest uptrend I have on any of my 200 or so charts. It's the 1975 to date, yes, half a century old uptrend. 1975 to date, uptrend currently at 65.95. I am not even going to give you my secondary harder to achieve target for this pattern, as it is below zero. Please, please, please bear in mind that these are very long-term targets, stretching possibly over many years. But there's still targets below for these patterns above. Now, that all being said, July, with changeover through a major spanner in the works for such long-term patterns. The reactionary immediate countering monthly key reversal up for July went back above the purple neckline, but stopped at the 50% absolute Fibonacci line at 180.5 and just under the newly drawn 2023 to date upper bear channel line, which is currently 182.75. Question this posed, and it's a longer term question, is whether this was just a recovery, single month move higher, or the beginning of something else. For now, I will continue to stick to the reactionary single month move higher, but I am prepared to start looking at the possibility of a new base of support, not only being built but also being exploited for a possible move higher. Now, there is one caveat to this basing higher idea, and it is something I've already mentioned: the newly drawn mid-2023 to date big bear channel, and that's currently 134 even to 182.75. Even with such a big reactionary move back up, we are still sitting within this big bear channel. And it does have the advantage of already having at least the minimum 5 touches necessary to legitimize it. For all this, I just keep reminding you we're dealing here with some very, very long-term patterns, and you should always bear that in mind. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpick and ADM Investor Services International Limited. And here comes the final important bit.